Hi guys, I know it's been a long time, but I've come up with another video where I would be explaining the PE ratio, its interpretation and few analysis. It's going to be very interesting. So without any further delay, let's go ahead. Welcome back. So now let's start with the calculation. Now I hope you guys are already familiar with the earnings per share ratio. Now it's going to be essential to know this because through this we will be calculating the PE ratio. Now basically earnings per share is PAT divided by the number of shares, that is profit after tax by the number of shares. Now what do actually earnings per share means is basically as the name suggests, earning per share, that is the earnings you will get after you purchase one share, right? Now for example, let's just assume through any figures or something we get the earnings per share is 10, right? So let me just write 10. Just for the sake of simplicity of calculation, the market price of say ABC share is 100. So it's quite evident that the PE ratio will be 10, right? Now what does this mean? What does actually this 10 value denote? Now actually this means that the investor is ready to pay 10 times more than the market value than the earnings per share of that particular stock. That is, he is ready to pay 10 times more. That is, he is ready to pay 100 instead of 10 for that particular stock. I hope I clear this. So basically the ratio could be 10:1. So for basically in order to purchase a share, he is ready to pay 10 times more than the value of the share. Right, so I hope the first part is pretty clear. So now we'll move on with the interpretation and looking at some live stocks or the actual representation of how it is actually shown in the different sites. Let's go ahead. Hello, so I am right now in the Money Control website, as you can see, and I'm in the Axis Bank. Okay, yeah, so now as you see here, this is the value which we targeting, right, the PE ratio. Now PE ratio over here is 76.19. Now that is, the investors are ready to pay 76.19 more times than the actual share price of the company. Well, this could have several interpretations and meanings, and just concluding to one point is not correct. Now one of the points could be that it could be overvalued. The other could be that the company is doing so well, the investors have so much confidence that they are ready to pay much more higher than they would have rather paid, right? Than the earnings per share as such, I would say in other sense. Now this 10 which I had showed you in the Excel sheet. Now, what is the basis? Like, how do we know whether this 10 is a very high PE or a low PE? We don't really know that. As in, how do we justify that this 76.19 is a very high PE for this industry, or is it very low PE for this industry? Now, coming to that point, now in PE, we usually need a basis or a set of comparison. Either we could compare it with its competitor or with the industry average, right? So I have taken a competitor just for the sake of example, HDFC Bank. So as you can see, this is the HDFC Bank, right? So the PE of HDFC Bank is 23.1, which is lower. Now another way of analysis is that when a PE is at a higher price, that is now Axis Bank was 76.19 and HDFC Bank is 23.1. So it's an ideal scenario or an ideal thought or instant analysis when invested could mean that Axis Bank is a bit expensive than the HDFC Bank, and HDFC Bank is a bit cheaper. But we cannot rely on this just because it's cheaper, you go and buy it. No, that's wrong, and that's totally wrong. And just because it's expensive, we do not buy it. That is also very wrong. As I mentioned earlier, there are two ways of comparing with the competitor and with the industry average. So as you can see, the industry PE over here, if you can see, the industry PE is 26.43. That is for the banking sector. This is the industry average. Now, HDFC Bank, talking about the HDFC Bank, it's lower than the industry average, whereas Axis Bank was much more higher than the industry average. Now, this could mean that it's kind of a bit more expensive. Axis Bank is a bit expensive, and it's overvalued, a little overvalued. That is more than what it should have been valued. And in such cases, the market actually corrects itself. But another interpretation, as I mentioned earlier, could be that the investors are so confident that they are ready to pay a very high amount for that particular share. And both of these interpretations are correct. Thus, a very good analysis should be done before investing in any of the companies, and just having this as a criteria is totally wrong. Now, I'm moving on to a different criteria as well. This will help in the interpretations later. So, let's go on to the NSE site. Now, in the NSE site, you can see that in the page here, you can just type NSE PE or PB ratio dividend, then you'll get this site. And as you can see on the screen, it's you can choose a date. I have chose a very latest date, that is from the 1st of June till the 12th of July, right? So, and I have selected PE, and let me get the data. So until it's loading, let me tell you that it's usually through statistics and through reads and through watching videos, I've learned that when the NSE is above a certain range, that is say about 22 to 21, it's usually said that the NSE or the index is overvalued. And when it's below 16, it's said that the index is undervalued. And in this case, it's the average, as you can see, I can make out, is about 26, say, and it's constantly rising, as you can see that it went from 22 to 28. So in these scenarios, now it's clearly overvalued, NSE is overvalued, but in these scenarios, the market usually corrects itself. Now, what do I mean by correct itself? Is through after a certain period of time, or certain there's like a fluctuation of demand or certain things, the market then will go on to its correct position, that is to go to the equilibrium position, right? Now, because of this, why have the markets gone up is could be because of the news. Now there's this coronavirus as well. So because of certain news, it might have gone up, but eventually it will go down, and that's why one must be careful that whether one should invest right now or not, just because the NSE has gone up and the markets are doing well. Knowing the equilibrium position is very important in order to know that whether this price is justified and whether it's the true value of the company. I think that's very much it from my side, and I hope you guys really enjoyed it, and I loved shooting this video. It was a great time. I learned a lot by analyzing certain things. I hope to do analysis in the next videos as well. After analysis of certain stocks like PE, PB ratio, dividend yield, etc., and individual share prices, I will go on to the balance sheet and P&L.